Elliot wave theory. Let's start with an introduction about Elliot wave theory, talk about what it is generally. In 1938, a man named Ralph Nelson Elliot invented a theory to describe how stock prices move, and he was specifically looking at stock indices, US stock indices, the Dow Jones, among others. Though his analysis is now used in not just stocks, but commodities, currencies, derivatives generally. So we can think of Elliot wave theory as a general theory of technical analysis that we can apply to any asset, but that was initially developed in the context of stocks. And much of the work on Elliot wave theory comes out of Dow theory. Now, if you remember, we talked about Dow theory a few lectures ago. In fact, it was the first lecture of this module. And Dow theory was really a theory about trends, right? Looking at minor trends, intermediate trends, major trends. And Elliot wave theory uses a lot of that information about trends and aims to improve upon it. So it's a slightly more scientific approach, slightly more technical approach, but it really talks about the same thing. How does the trends move in stock prices going up and going down? Differences in Elliot wave theory, we talk about waves. So we talk about prices moving in waves. Okay? So a wave is like one movement upward would be a wave. The next movement downward would be another wave. So we talk about the pattern of waves that we are likely to see whenever we analyze stock prices. And it works in much the same way Dow theory talks about prices moving in trend. Basic tenets. So now we want to create the building blocks of Elliot wave theory. Wave theory consists of three concepts. We have the pattern, the ratio, and the time. So let's talk about what each of these things are. So according to Elliot wave theory, the first concept we need to look at is the pattern. That is, the wave theory tells us that we should see a certain type of pattern in stock charts. Okay, that's the pattern. The second part, the ratio, talks about the length of the patterns. So if we look at the size of different movements, how far up or down does it go? It should move in certain ratios, and these will be Fibonacci ratios that we'll see later on. And the last concept is time. So there should be time frames within which Elliot wave theory moves, within which we see up waves and down waves. Okay, and they actually go in order of importance. So the most important is pattern, followed by ratio, and then time. And we'll see towards the end that time is actually sometimes not even used. It's not considered as important as the other two. So we'll start talking about the pattern first when we talk about the basic tenets. So stock markets follow a repetitive pattern of a 5-wave advance followed by a 3-wave decline. Now just think of a wave as a straight line going either up or down, right? So a straight line maybe diagonally because we're also moving across in time. So an up movement would be a diagonal line upwards, a down movement would be a diagonal line downwards, and these would be waves. So in general, we will see a 5-wave advance followed by a 3-wave decline. Now I'm going to talk about this as if we are in an uptrend. So in an uptrend we'll see a 5-wave advance and a 3-wave decline. In a downtrend we would see a 5-wave decline and a 3-wave advance. So you can just reverse it in your head when we're talking about downtrends. But throughout this lecture we'll talk about it in the context of uptrends. So during an uptrend, during the first 5-wave advance, we have 5 waves which we number 1 through 5. Now waves 1, 3, and 5 are called impulse waves. They move with the trend. So if we're in an uptrend, wave 1 will be upwards, wave 3 will be upwards, and wave 5 will be upwards. And waves 2 and 4, which come in the middle of those two, are going to move against the trend. Okay, so wave 2 and 4 are corrective waves. Now if we have a wave upward, the next wave is always going to be in the opposite direction. Right? So if following an upward wave, we'll always have a downward wave, and vice versa. So wave 1 will be an upward move, then we'll have a downward move wave 2, upward move wave 3, downward move wave 4, and then upward move wave 5. So that is the 5-wave advance. And following the 5-wave advance, we will have a 3-wave correction. The three-wave correction we will label as wave A, wave B, and wave C. And in this three-wave correction, we'll see wave A downwards, wave B upwards, and wave C downwards. So 2 out of those 3 will be downward moving, and that will be an overall correction. So now we will go ahead and look at what this actually looks like in terms of a pattern, and we'll see how we can use this analysis. Basic pattern. What we have here is the basic pattern of wave theory that we just talked about in the last slide. So now you can see my red pointer on the screen. The labels I've put are the waves. So 1 refers to wave 1, 2 refers to wave 2, etc. And we also have wave A, B, and C at the end. So let's go through this. So we have a 5-wave advance, and we have a 3-wave decline, which comes at the end. So the 5-wave advance works as follows. This line here is wave number 1. Okay, that's an upward moving wave. This wave here is wave 2. This wave here is wave 3. This wave here is wave 4. And this wave here is wave 5. Now what is important to know is that the entire line, so like from here, for example, all the way down to here, that represents the wave. So the whole movement is that wave 1. Now what we can see from here is that wave 1's, wave 3, and wave 5 are impulse waves. They move in the direction of the trend. So here we have an uptrend, alright, because we've got the 5-wave advance that goes up, and the 3-wave advance that decline that goes down. So waves 1, 3, and 5 are going up. Waves 2 and 4 are these smaller corrective waves. Okay? So from wave 1 through 5, we now have our 5-wave advance. So we're starting at this point down here, and we're ending up at this point up here. This is the 5-wave advance, the first part of the waves. After that, we have the 3-wave decline. And that's going to be wave A over here, wave B over here, and wave C over here. In this case, we can see that the overall outcome of the 3-wave decline is a decline from this point here to this point. We have a decline first, then a small upward correction, and then another decline. And this is the 3-wave decline. So according to Elliot wave theory, stock prices move in this pattern. We'll see a 5-wave advance followed by a 3-wave decline. And this we should see repetitively. Wave subdivisions. The next concept we want to talk about are what is known as wave subdivisions. Now, the wave cycle we're talking about, that is the 8-wave cycle, will exist no matter what time frame we are looking at. So according to Elliot wave theory, we recognize that there are different degrees of trend, from very long term to very short term. So we can have trends that last a few hours, a few days, weeks, months, and even years. So we can have any different length of trend. And we should see this 8-wave cycle no matter what time frame of trend we are studying. So whether we are studying a yearly trend or a daily trend, we should still see the same 8-wave behavior. So how does this manifest itself in the pattern itself? Well, what we will see is that each wave subdivides into waves of one lesser degree. Okay, so we can break down a particular wave movement into further waves. And we'll see what this looks like in the next slide when we actually look at the pattern. But you can just think of it this way. So if we have wave 1, for example, if you remember wave 1 on our last slide, that was an upward wave, right? That was 1 out of the 8 pattern. That upward move can also be divided into additional waves. So if you remember waves 1 and 2, so a move up and then a smaller move down, that was 2 waves. We can subdivide that into an 8-wave pattern. Okay? So the first 2 waves that we saw on the previous graph, waves 1 and 2, we can subdivide that into 8 waves, 5 going up and 3 going down. So we create this 8-wave cycle. So 2 waves can subdivide into 8 waves, which can then subdivide into 34 waves, which can subdivide into 144 waves. And these numbers are actually part of the Fibonacci sequence. These two, 34 and 1, 8, 34, 144, and 2, which we'll discuss later on, as we said. So this is kind of showing you, starting out now, the underpinnings of Elliott wave theory, how it kind of ties in with this Fibonacci number sequence. So what's important to note is that it's just like looking at major trends, minor trends, and intermediate trends. So you have a minor trend, and that will be part of some intermediate trend. You'll have various intermediate trends that are part of a major trend. So it's just like that with waves. You have wave cycles. A small wave cycle would be part of another bigger wave cycle, which will then itself be part of an even bigger wave cycle. So we will have these wave subdivisions throughout. Let's now take a look at a pattern and see what this looks like. Subdivision pattern. Okay, so now I've essentially drawn for you what is the same graph as before, but with more waves. And if this looks a little complicated, we'll just go through it step by step. It should be fairly clear. So what we have here, okay, is I have labels for each of the waves, and each of these represents a different wave sequence. So the black labels, so whenever we have a label in the color black, that represents the very short-term wave sequence. Blue slightly represents a slightly longer-term wave sequence, and that's what we saw. This is equivalent to the wave sequence we saw in the first slide. And green, which you can see there's just 2 of them, one here and one down here, represents an even longer wave sequence. So now imagine an uptrend. Let's look at these step by step. So I'm going to start with the green. Okay, so we just have 1 here, alright, and we have 2 here. So in this case, all we have are 2 waves. We've got, starting here, that's wave 1 up to there, and then here the corrective wave down is wave 2. So I'm not even showing the 8 wave cycle on this, is just 2 waves. Right, so that is the largest trend we have on this pattern. Then we have the next trend, which is the blue ones. So in the blue ones, it's going to be similar to the picture we saw before. We've got a 5 wave advance. 1, that's the first wave. That's down to the second wave. That's the third wave. That's the fourth wave. That is the 5th wave again. Then we will have the ABC correction. A wave down here, B down here, B up there, and C down here. Right? And you can see these correspond to the blue values. So that now is the 8 wave pattern across this whole graph, right? 5 up and 3 down. And now within all of these, we are going to see small 8 wave patterns throughout this. So looking at the near term trends, we have an 8 wave pattern that starts here, okay, and that ends over here at C, right? So starting at 1, ending at C. So we have 1, 2 down here, 3, 4, 5. That is the upward movement. And then we have the ABC correction, 1, 2, 3. So this from here to here completes an 8 wave cycle of the, I guess, the shorter term trend, right? The most shorter term trend on this graph. And likewise, we have the same thing here. We have 1, 2, 3, 4, 5. That is the 5 wave upward movement, followed by ABC correction. And that is this another 8 wave pattern. And again, 1, 2, 3, 4, 5. Alright, and then and then actually we're going to stop here. It's not going to be an ABC correction, sorry. So we've got 1, 2, 3, 4, 5 to up here. And this is where it actually ends. So now what we will have is we're going to have it go the other way. Right? Because it's now going down, what we will see is that we have 1, 2, 3, 4, 5 going down, and the ABC correction will be going up because the trend is now changed. The short-term trend has changed, right? So our long-term trend in this case is still up, but our short-term trend has changed. So in this case, we've got 5 going down and then 3 going up, ABC correction, and then another 5 going down, 1, 2, 3, 4, 5. And then if we draw it again, there'd be 3 going up, and so on and so forth. So now you can see from this pattern that we can subdivide waves into smaller waves, and each wave pattern comprises another larger wave pattern, and this can keep going on repetitively. So we have 3 different wave cycles we're showing on this one picture, and we can show even more if we wanted to. Corrective waves. So now we have talked about the general pattern of waves. We've looked at the 5-wave upward pattern followed by the 3-wave downward pattern, and we've looked at how that looks on its own, and then we've also looked at how it looks when we subdivide it into smaller waves. The next thing we're going to talk about are what are known as corrective waves. So if we're looking at the 8-wave sequence, the 1 through 5 sequence is the impulse waves, right? The major trend, in the one that goes in the direction of the trend, and the ABC are the corrective waves. So I want to spend a little bit of time talking about those corrective waves and how we can recognize them, and how they are different from the 5-wave advance. So the first thing to know is that the impulse waves, that is the ones in the direction of the major trend, come in 5s, as we've seen, and corrective waves almost always come in 3s. So we're most likely to see an ABC pattern for corrective waves, and they pretty much never come in 5s. Now again, everything we're talking about is what the theory is telling us. So if I say to you, waves come in 3s or waves come in 5s, you need to take that as, this is what the theory says, this is what we are likely to see. This is not what will happen all the time, right? So sometimes you will see a corrective wave in 5. I'm sure if you look for it, you will find it. The point is that we're looking at what happens the majority of the time. So just keep that in mind throughout the rest of this lecture, because what we're going to be doing is talking about different attributes of that wave pattern, different things that we are going to observe, and just take them as this is what we are likely to observe. So what are other things we can say about corrective waves? In general, they are more difficult to identify and more difficult to predict. This is as compared with the normal impulse waves. So the 3-wave pattern is harder to see and spot as compared with the 5-wave pattern. We are going to go through 3 different types of corrective waves. They are called zigzags, flats, and triangles. We'll look at how they work, and these are 3 different patterns we can expect to see when we find corrective waves. Zig-Zags. This is the first of the 3 corrective wave patterns we will look at. They are called zigzags. So this is a wave pattern that goes against the major trend, right? Again, all the corrective waves are going to be ones that are going against the major trend. It can be a bullish or bearish pattern. So in the diagrams that you see below the writing, I've shown you what it looks like when the price is going down overall, when the overall trend is down. So that will be following a 5-wave advance. This is a 3-wave decline. And this can go the other way too. So if we had a 5-wave decline, we could see a 3-wave advance. So it could be a bullish or a bearish pattern, depending on what occurred first. So we will just show it in this state where it is going down, and you can imagine it'll be the same when it's going up. The main characteristic of the zigzag is that we break down into a 5-3-5 corrective sequence. So the zigzag has 3 waves, A, B, and C, and each of those waves has its own number of waves. So the A wave has 5 waves in it, B has 3 waves in it, and C has 5 waves in it. So that is the 5-3-5 sequence. The other thing to note is that the B wave does not reach the beginning of the A wave. So if you look at the picture, we see the A wave from the top of the A wave to the bottom of the A wave. The top of the B wave does not reach where the A wave started. And the C wave goes beyond the end of the A wave. So if you can see the C wave, now just look at the picture on the left here. The C wave falls below the end of the A wave. Okay, so I'm just going to use my pointer here. So we have the A wave which is this one, and you can see that it goes from here to here. Then we have the B wave, which is this one, that ends here, and this does not reach the beginning of the A wave. So it always ends up lower than this point here. That's what we need to know. And then we have the C wave, which is this one, and this wave ends up lower, that is this point here, ends up lower than the A wave. Okay, and the same thing would be if we reversed it as well. So this is the basic pattern, what it looks like. Now let's look turn to the right side, and we will see we want to look at the corrective 5-wave sequence here. So we have 5 waves, 1, 2, 3, 4, 5, going down to A. So this whole thing, okay, is the A wave, right? This whole thing here is the B wave, and this whole thing here is the C wave. Now this, you can see there are 5. There's 1, 2, 3, 4, 5 in the A wave. There's 1, 2, 3 that make up the B wave, and there's 1, 2, 3, 4, 5 that make up the C wave. So that is the 5-3-5 sequence, and this is a zigzag. Flats. The next corrective pattern we would look at is what is known as a flat, and like the zigzag, it is also a 3-wave corrective pattern. So it's going to consist of the ABC wave, and it is going to go against the major trend, just like the zigzag. The main difference is that it is more of a consolidation pattern. So while the zigzag pattern was either bullish or bearish, so it either had an overall downward or overall upward movement, as we saw. So in the previous picture we saw it as an overall downward movement, but it can also be the other way around. The flat pattern is more of a consolidation, whereby we don't see much overall movement. And this is also an ABC wave pattern, so it comes following a 5-wave pattern before it. Now the main difference between this pattern is that instead of a 5-3-5 sequence, it's going to break down into a 3-3-5 sequence, and I'll go through the diagram as well. And the other thing to note is that the length of the waves are roughly the same, A, B, and C. So we'll have the B wave that reaches the beginning of the A wave, and the C wave that reaches around the same level as the A wave. So let's look at the picture and see what we can understand from it. So I'll start on this side. So this is what the flat looks like. So now we are on the left side. This is what the flat pattern looks like. We have our A wave here, we have our B wave here, and we have our C wave here. So here we have waves of roughly the same length. We have the A wave that goes from here to here. Now we have the B wave that reaches the level that is the beginning of the A wave. So this level here should be around equal to this level here. Right? If you remember the zigzag, the B wave only went up to, didn't go all the way up. Following that, we have the C wave, which goes from here to down here. And this should reach around the same level as the A wave here. So this should be at the same level as here. So that is what the flat pattern looks like. Now let's look at the 3-3-5 sequence. So we will have from here to here is wave A. From here to here is wave B. And from here to here is wave C. And these are the points where the waves start and end. So just draw those in there. So now we have a 3-3-5 sequence. So A wave has 3, which is 1, 2, 3. The B wave also has 3 waves, 1, 2, and 3, and the C has 5 waves, 1, 2, 3, 4, 5. And this is what the flat pattern looks like. So we have the 3-3-5 sequence, and we have the waves reaching approximately the same length, and this resulting consolidation pattern. Rule of alternation. The rule of alternation is a separate concept in Elliot wave theory. So now we've gone past looking at corrective waves. We're going to look at a couple of other details about Elliot wave theory before we move on to Fibonacci analysis. So one of these things is called the rule of alternation. According to the rule of alternation, the market usually doesn't act the same way 2 times in a row. What this means is that if we see a particular pattern occurring, we are unlikely to see that same pattern the very next time the market moves. So for example, let's say we see a head and shoulders top. So we see a standard head and shoulders pattern, and the next time the market makes a top, we are unlikely to see the same pattern. So that is the rule of alternation, is that we're not likely to see the same pattern 2 times in a row. If we see a head and shoulders pattern once, we might see a different type of top pattern the next time. And really this is telling us more about what not to expect rather than what to expect. So if we've seen one particular pattern, this tells us that next time we should not expect the same pattern to occur. And the other thing about the rule of alternation, so there's also the word alternation. Alternation means taking turns, one after another, but then coming back to the initial one after skipping it once. It's alternating. So we will often see corrective patterns alternate. So if you remember, we talked about the different corrective patterns. So we might have a zigzag could be one of the corrective patterns, and then we could have a triangle in the second corrective pattern, or we could have a flat. So there are these different types of corrective patterns, but we are very unlikely to see two zigzag corrective patterns in a row. We normally like to see a zigzag, then maybe a triangle, and then maybe back to a zigzag. So that is the rule of alternation. And often what we also see is that simple patterns will alternate with more complex patterns. So this could be anything. We could see, for example, a simple double top followed by a more complex triple top, right? It really could be anything. You just have to use your imagination here. And this is just an empirical observation, so saying that corrective patterns often alternate between one another, and also saying that simple patterns often alternate with complex patterns. And this is the rule of alternation. Price channels. Now we will talk about a concept known as channels, and we have seen channels before. Let me just refresh your memory. So when we were talking about drawing trend lines, that is connecting the lows or highs on a graph to make a trend line, we can also draw a parallel line which creates a channel. The parallel line will be on the other side of the price, such that the price movement occurs within the channel. So that was a channel. And price channels are quite central to Elliot wave theory. According to the theory, waves often take place within channels. So we can draw this channel and we should see all our movement, all the waves taking place within this channel. So again, a channel consists of two lines which encompass the price movement. How do we draw a channel? Well, when we have an uptrend, we draw first the trend line, which will be below the price, and then we draw a parallel line which is above the price, and that becomes a channel what the prices move within. So the prices move within the channel, and by wave theory the waves are moving within that channel as well. So what will happen if the wave sequence breaks that channel? Well, if a particular wave sequence breaks a channel, then we would need to redraw the channel lines. So it doesn't necessarily mean that the channel is wrong, it just necessarily means that the channel has changed. So if there's a sharp upward move, let's say we have an uptrend, we may have to change the slope of the channel so that it goes up even, it's steeper, indicating a faster uptrend. So we can redraw the channel as we see if we have an instance where the price or the wave breaks the channel. Now one of the other important features about channels is that during an uptrend, so during an uptrend and during the 5-wave sequence, the waves 1 through 5, wave 5 should come close to the upper channel line. So on the channel, during an uptrend where price is moving within that channel, on the 5th wave we should be coming towards that channel line. Right? So that's kind of tells you where your channel should be in relation to where the price is.